Gold. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we will look at gold. We have a 5% move here from the 52-week low and a 10% pullback so far. Yeah. And gold has been very slow. Certainly for the bulls, it's in a pattern that still is very much bullish, but the expectation was that it would have a major breakout way sooner, but it's really taking its time. So during this process we formed, well, let's draw it a bit more correctly. So here we formed this major rounding bottom. We do have a breakout, and this is the gold futures. Then we form a handle. So this is a cup and handle technical pattern, which is bullish, but it's taking a lot of time to form. If we do measure the duration of this pattern here, that was 574 days, and this is currently around 469 days. If we were to take 547-ish days for 574 days here, that would push us into February of 2022. The expectation is that we will start to rally. The case, for higher gold prices is strong. Gold has faced some competition from Bitcoin and other cryptocurrencies, but there's a very huge difference. Gold has the entire military-industrial complex in all countries on its side. The central bankers are in favor of gold. So the big players out there, extremely powerful people, they like gold, and they will protect gold. So this, and I think that this competition also between gold and cryptocurrencies is very unfortunate. Very, very unfortunate indeed. But I think that the backdrop here with money printing and all of that, you could certainly make a strong case for gold. The problem with gold is that it is the mother of finance. So it's a different animal altogether, which means that it's very difficult to fully understand gold. What we do know for sure is that when you look at human civilization over thousands of years, civilizations from civilizations to civilizations, that is, empire to empire, gold is the hedge that has stood the test of time. Which means that, yes, I think that in this context I would be bullish gold. But it's been a boring and very annoying trade. It is what it is. Looking here at the daily data points, we do unfortunately have some key resistance here from the all-important red 200-day moving average. We were rejected here on Friday. There are definitively some bears here, and the bulls, they have much to prove. Yeah, they just do. But we are at a low level. It would make more sense to be more aggressively bearish after a big rally. The risk reward for hedging or shorting is just better there. Looking at the PPO RSI, we are at relatively low levels. When we go here to the daily data points, then we are a bit more in the neutral zone. Yeah, it's a bit messy. Let's look at the correlations. So long term, we do have 66% correlation with the S&P 500, 50% with Bitcoin, and minus 88% negative with the 10-year yield, which is pretty darn strong. When we look at it historically, though, over a longer time period, we are at a very low level. We usually don't have this negative of a correlation. Looking at the dollar index, there's a 60% negative correlation, and we are also at a historically low level of that correlation. On the daily data points, 18-ish positive with the S&P 500, minus 51-ish% with the Bitcoin, minus 11 with the 10-year yield, and then minus 67% here with the dollar index. Looking at the seasonality over the last 5 years, December is the strongest month. January is also strong. November is a bit 50-50. Over the last 10 years, then we do see that November is pretty weak, but December and January are strong. Over the last 20 years, and that is the biggest picture we get here, from October to November, December, January, we do see strengthening seasonality, meaning that the risk-reward is skewed in favor of the bulls. Especially January is very strong. So, given that we have seen a major pullback in gold and we are at a low level, it's a bit interesting from a more contrarian, bullish perspective. So here we have the GLD ETF, the gold ETF. We do have these diagonal trend lines support, rejected from resistance. Here is the gold ETF, it has an almost perfect score, 0.40% expense ratio, assets under management 56 billion, average daily dollar volume over 1 billion, so extremely liquid and highly tradable. And the reason why I analyzed futures here is because the futures are traded more hours than the GLD ETF, which means that we have more price data, which always is, beneficial. The more data you have, the better you can do, the better you can analyze the security. Taking all the evidence together, I do have a bullish lean, and we are at a low level. We are in this very big cup and handle pattern, which is a technically bullish pattern. The macro picture is bullish for gold. The huge rally in Bitcoin could also put Bitcoin in a more vulnerable situation, which could benefit gold. So yeah, I lean bullish. But always, of course, you do want to have stops.